What if I told you that Trump's tariffs are not just about higher taxes, but about the collapse of a global industry? What we are witnessing with the closure of Chinese factories is just the beginning of a much larger phenomenon that will affect global trade in the coming years. Factories that once produced for the United States are now struggling to survive, and many are shutting their doors. But the impact goes far beyond that. With this trade war, we are witnessing a reconfiguration of global supply chains, with new players taking control and China trying to change its own strategies. Now, imagine what this means for the prices you pay on the products you consume every day. How will China react to this new reality? And what will this mean for the brands that continue to profit exorbitantly from cheap production made in Chinese territory? If you haven't been following this global transformation, now is the time to open your eyes. We'll show you how Trump's tariffs are shaping a new future for Chinese factories and global trade. And if you think this doesn't concern you, you'd better think again. Get ready, because what's coming might change your understanding of how the world works. And don't forget to comment below if you want to learn more about how all of this is being orchestrated behind the scenes. When Donald Trump took office as President of the United States, his aggressive economic policy focused on reducing the trade deficit with China. In 2018, the US government imposed tariffs of up to 25% on a wide range of Chinese products, which directly impacted factories in China, especially those focused on exports. These tariffs aimed to correct the trade imbalance and were described by Trump as a form of punishment for unfair trade practices, such as currency manipulation and intellectual property theft. As Trump stated in an interview with Fox News in 2019, the tariffs are a way to force China to be fairer, as there is a huge difference in trade between our countries. The impact of the tariffs was immediate and devastating for many Chinese factories. Companies that had once relied on strong demand from the US market now faced higher costs, which reduced their profit margins and made them less competitive. Data from Reuters in 2020 revealed that, shortly after the tariffs were imposed, about 20,000 factories in China reduced their operations or shut down due to high costs and reduced demand. Moreover, many of these factories depended on the US for a significant portion of their production, and the increase in tariffs led to a sharp decline in exports to the American market. The factory closures also triggered a series of collateral effects on the Chinese labor market. Regions such as Guangdong and Zhejiang, which had once been major industrial hubs, saw a rise in unemployment as production was transferred to other countries or cut back. The Chinese government attempted to mitigate the economic impacts with fiscal stimulus packages and incentives for new industries, but these efforts were not enough to fully compensate for the decline in production. In an interview with the Wall Street Journal, economic analyst Li Wei highlighted, the loss of competitiveness in the global market was inevitable, and this resulted in a significant economic slowdown in various regions of China. Trump's decision to impose these tariffs also profoundly affected global supply chains. Chinese factories that provided essential components for various international industries, such as electronics, automobiles, and apparel, had to face rising costs, causing many companies, particularly in the technology sector, to seek new suppliers in other countries. A report published by the Financial Times in 2020 revealed that more than 40% of Chinese manufacturing companies were seeking to relocate their operations to countries like Vietnam, India, and Mexico in order to avoid US tariffs and keep their businesses running. However, factories that remained in China sought ways to adapt. The Chinese government encouraged innovation and technological modernization as a way to improve competitiveness. In a 2020 speech, President Xi Jinping stated, China must improve its ability to innovate and, at the same time, move toward industries with higher added value. This will help us face the uncertainties of the trade war and make us more resilient. Nonetheless, the reliance on the American market and the rise in tariffs represented significant challenges, and many factories are still trying to find a new balance in an increasingly fragmented global market. The imposition of Trump's tariffs not only affected Chinese factories, but also forced a radical transformation in production and export strategies. Many of these factories, which had once thrived by exporting to the United States, now found themselves facing a critical dilemma: adapt to the new conditions of the global market or face bankruptcy. For some, adaptation was a matter of survival, while for others, closing down was the only viable option. In 2019, President Donald Trump stated in an interview with Fox News that China was being extremely dishonest in its trade practices and that the tariffs were a way to correct this trade imbalance. According to Trump, "We are going to impose very high tariffs because China has been manipulating trade for a long time. They are going to pay these tariffs, and Chinese factories are going to have to adapt." This created immense pressure on Chinese factories, particularly those dependent on the US market, which were now forced to rethink their strategies. One of the first steps toward adaptation was the relocation of operations. Companies began moving their factories to countries where tariffs were lower or non-existent, such as Vietnam, Indonesia, Mexico, and even countries in Africa. This movement was not surprising. As early as 2019, a survey revealed that about 30% of Chinese companies were relocating their operations outside of China due to the higher costs imposed by the US trade war. For these companies, the goal was to bypass the tariffs and continue offering products at competitive prices. This migration was not only an economic strategy but also a necessity in the face of the pressure from Trump's tariffs. At the same time, other factories attempted to reduce production costs through technological innovations and increased automation. Investing in more efficient machines and low-cost production technologies became essential for those wanting to remain competitive despite the tariffs. Xiaomi's CEO, Lei Jun, mentioned at a 2020 conference that the only way to compete with the US in the future will be through innovation and automation because tariffs are making it harder to produce cheaply. Automation not only helped reduce labor costs, but also allowed Chinese factories to improve their production capacity, maintaining competitiveness in the global market. However, this strategy also required significant investments in new technologies, which not all companies were willing or able to make. For small and medium-sized Chinese companies, however, adaptation was much more difficult. These companies lacked the capital or resources to move to other countries or invest significantly in technological innovation. Many of them, which were concentrated in low-cost and low-value-added sectors, couldn't remain competitive and ended up closing their doors. The loss of competitiveness was evident, and many of these companies that had once been at the heart of global production began to disappear from the market. In 2020, a study revealed that approximately 40% of small manufacturing companies in China shut down or drastically reduced their operations due to Trump's tariffs and the trade war. For some of the companies that survived, adaptation did not necessarily mean a return to what it was before. They began to focus on different markets, such as Europe and Asia, to diversify their customer base and reduce reliance on the American market. However, this also meant a shift in the dynamics of the global supply chain, with many companies now pushing for the diversification of their trading partners. This market redirection was a way to soften the impact of Trump's tariffs, but at the same time, it challenged Chinese factories to reinvent themselves in an increasingly competitive market. Finally, the adaptation of many Chinese factories to the new post-tariff reality also involved rethinking production. Quality became a key factor, and many factories started focusing on higher-value products with greater profit potential. Instead of competing solely on price, they aimed to target market niches that allowed for higher profit margins and less vulnerability to the fluctuations caused by tariffs. This move, however, was not enough to fully reverse the damage caused by the tariffs, and many of these factories are still struggling to find stability in a volatile global market. The impact of Trump's tariffs on Chinese factories was not isolated. It reverberated throughout global trade. When tariffs of up to 25% were imposed on products manufactured in China, the immediate reaction was a slowdown in Chinese exports to the United States. This move, which initially seemed like a strategy to make China pay, ended up generating a series of consequences that affected other countries and markets around the world. As Donald Trump stated in a 2018 press conference at the White House, China will no longer take advantage of us, and the world will see that tariffs are changing the global dynamics of trade. Global supply chains were heavily impacted by the tariffs. Many industries that relied on components made in China, such as the technology sector, faced significant difficulties in keeping their costs low. Companies like Apple, Samsung, and other tech giants had to reconsider their supply sources, leading to a reconfiguration of global production chains. According to a 2020 Reuters report, 45% of electronic component manufacturers reported difficulties in obtaining materials from China after the trade war began, forcing them to seek alternatives in other Asian markets, such as Vietnam and India. Moreover, the trade war also created a cascading effect in global markets. As tariffs increased, the price of a range of products, including electronics, clothing, and even automotive components, rose significantly, hurting consumers worldwide. The price increases in the United States, for example, were felt across various sectors. A 2020 study by the Brookings Institution showed that Trump's tariffs increased the average cost of imported goods by about 12%, directly affecting the purchasing power of American consumers. However, while the United States was forced to pay more for a range of products, China also faced its own challenges. The tariffs not only reduced the competitiveness of Chinese products in the global market, but they also caused a slowdown in China's economic growth. The Chinese government was forced to reassess its dependence on the American market and seek new markets, particularly in regions like Europe and Southeast Asia. In a 2020 report, China's Ministry of Commerce stated China is making efforts to expand its trade partnerships outside the United States and strengthen relations with the European Union and BRICS countries. This market realignment was not simple. Although China managed to increase its exports to emerging markets like India and Brazil, the cost of adapting to the new conditions of global trade was high. The impact on supply chains led to a fragmentation of the global market, which increased production costs and reduced the efficiency of companies. Additionally, the uncertainty generated by the US-China trade war negatively affected investor confidence, resulting in a slowdown in global investment flows. The World Trade Organization predicted in its 2020 report that global trade would fall between 10% and 15%. Due to the uncertainty caused by Trump's tariffs and other geopolitical factors. Finally, the impact of the tariffs also prompted a shift in the dynamics of global trade alliances. Countries that were within China's orbit began to rethink their trade relations, and new strategic partnerships started to emerge. The entry of markets like Vietnam into the global manufacturing game and the increasing influence of Mexico as an alternative to Chinese supply chains were some of the most notable changes. The reconfiguration of global supply chains is one of the largest consequences of the trade war, and the effects of this transformation are still being felt in global trade. The Chinese government's response to the tariffs imposed by the United States was an effort to balance the economic damage caused by the trade war while trying to reverse the loss of competitiveness of Chinese factories. Since the onset of the trade war, Xi Jinping's government has adopted a series of measures to try to mitigate the effects of the tariffs, including economic stimulus packages, subsidies for certain industries, and investments in technological innovation. The goal was both to stabilize the domestic economy and seek alternatives to keep China competitive in the global arena. In 2019, the Chinese government announced a stimulus package of 2 trillion yuan, approximately $300 billion, to support industries affected by the trade war. These resources were primarily allocated to small and medium-sized manufacturing enterprises, which were most exposed to the impact of Trump's tariffs. The Minister of Industry and Information Technology, Miao Wei, stated at a press conference that China is committed to supporting its essential industries by providing subsidies and fiscal support to ensure that the manufacturing sector remains competitive in the face of external challenges. However, this injection of resources was not enough to prevent the significant slowdown in production at many factories, particularly those more reliant on the US market. Additionally, the Chinese government also encouraged the diversification of exports to new markets. With the reduced demand in the United States due to the tariffs, China turned to Southeast Asia, Africa, and even Latin America in search of new trade partners. China Daily reported in 2020 that the Chinese government is expanding its trade relations with the European Union and promoting free trade initiatives with other developing countries to reduce its dependence on the US market. This helped keep Chinese exports growing, but also highlighted China's vulnerability to political and economic uncertainty in the global landscape.